Thank you, Anthony. We've had a solid start to the year. Our innovation in brand building is powering exceptionally strong revenue growth. In the first quarter, adjusted net revenue grew 41% to $1.1 billion. This is a further acceleration in the growth rate from the prior quarter. Importantly, we generated $1.1 billion in cash revenue in Q1, which includes approximately $690 million from net interest income and approximately $390 million from interchange fees, brokerage fees, technology and loan platform fees, and loan origination fees. Cash is defined and accounted for the same universally, no matter what type of company it applies to. In the first quarter, these cash revenue streams were nearly equivalent to our total reported adjusted net revenue. This is the first time we have disclosed our cash revenue, as we think it's a helpful financial measure to consider given the different accounting treatments companies use. As we mentioned, it's our second consecutive quarter of more than $1 billion in cash revenue. But I would also note that 100% of our reported adjusted net revenue was cash revenue in both 2024 and 2025. This means that the scale and seasoning of the loans on our balance sheet has reached the point where the upfront non-cash premiums on new originations are being balanced by pulled apart and other mark-to-market impacts on the existing portfolio, leaving the vast majority of our reported revenue being approximately equal to our cash revenue. Here, mark-to-market is an accounting method that values assets based on their current market price rather than their original purchase cost. We have consistently said that over the life of the loan there's no difference between fair value accounting and cost accounting, and we are seeing that play out in our reported results. In addition to our strong revenue growth, we delivered strong profitability during the quarter. Adjusted EBITDA was $340 million, up 62% year-over-year at a margin of 31%. Net income was $167 million at a margin of 15%. Net income was up 2.3x year-over-year and earnings per share was 12 cents, which was negatively impacted by 1 penny due to a decrease in discrete tax benefits related to employee stock compensation given share price movement between Q4 2025 and Q1 2026. At a constant share price, quarter-over-quarter EPS would have been 13 cents. This was our 10th consecutive profitable quarter. Turning now to our segment performance. Starting with financial services, for the first quarter, financial services net revenue was $429 million, up 41% year-over-year. Contribution profit was $196 million, up 32% from last year. And contribution margin was 46%. Net interest income for this segment was $228 million, up 31% year-over-year, which was primarily driven by growth in member deposits. Non-interest income grew 55% to $201 million for the quarter. During the quarter, we continued to see healthy growth in interchange, up 54% year-over-year, driven by nearly $25 billion in total annualized spend across money and credit card. We also had record brokerage fee revenue, which more than doubled over the past year. In terms of our loan platform business, one of our key differentiators at SoFi is having both a very strong balance sheet and an established loan platform business supported by a diverse set of partners that go well beyond private credit asset managers. In fact, during the quarter, we added $3.6 billion of new commitments with 3 new partners, including a leading global bank, a prominent insurance group, and a top 5 global private asset management firm. Our diversified model allows us to efficiently channel loan volume based on a number of factors, including borrower demand, capital levels, and credit risk, with a focus on maximizing risk-adjusted returns. Each channel we utilize provides benefits to our business. For example, our balance sheet lending generates stronger revenues over the life of the loan, whereas LPB generates capital-light fee income with no retained credit risk or loss-share agreements. Having this optionality will allow us to generate more consistent growth through a variety of environments. Overall, during the first quarter, we saw exceptional demand from members, which is reflected in our record personal loan originations of $8.3 billion. Given our very strong capital ratios, we channeled nearly $5.4 billion of personal loans to our balance sheet and approximately $3 billion through our loan platform business. This deliberate decision resulted in lower LPB originations relative to the fourth quarter, although LPB originations were up 90% year-over-year. I would note that we had significant demand from LPB partners over and above what we decided to fulfill this quarter, but we did fill all demand from our contractual commitments and more. Turning to our tech platform business, where we delivered net revenue of $75 million in the first quarter, reflecting the exit of a large client who fully transitioned off our platform prior to year-end. Contribution profit was $12 million at a contribution margin of 16%. Turning to our lending segment performance, which was very strong during the quarter. In addition to record personal loan originations of $8.3 billion, we also saw record originations in student and home loans. Student loan originations were $2.6 billion, up 2.2x from the same period last year. Home loan originations were $1.2 billion, up 2.4x from the prior year. For Q1, adjusted net revenue for the segment was $629 million, up 53% from the same period last year. Contribution profit was $382 million with a 61% contribution margin. These strong results were primarily driven by growth in net interest income, which increased 39% year-over-year to $500 million. And the balance of the growth came from loan origination fees, which were up 36% year-over-year, and home loan sales, which were up more than 2x year-over-year. Capital markets activity was strong in the first quarter. We sold or transferred through our loan platform business $3.8 billion of personal and home loans. In terms of home loan sales, we closed $765 million at a blended execution of 102.1%. Additionally, we sold $89 million of late-stage delinquent personal loans in line with prior quarters. In addition to our loan sales, we executed a $919 million securitization of loans originated on behalf of our partners through the loan platform business. The transaction priced at an industry-leading cost of funds level with a weighted average spread of 86 basis points, our best execution for any securitization deal to date. Here, securitization is the process of pooling various types of debt, such as loans, and selling them as consolidated financial instruments to investors. To meet standard industry risk retention requirements, we contributed loans from our balance sheet that represented a 5% vertical slice across the securitization's tranches. Importantly, we do not retain any first loss or horizontal risk position. Turning to credit performance, our credit remains strong, performing in line with our expectations and driving attractive returns across all loan types. Our personal loan borrowers have a weighted average income of $154,000 and a weighted average FICO score of 745, while our student loan borrowers have a weighted average income of $161,000 with a weighted average FICO score of 767. For personal loans, the estimated all-in net charge-off rate was flat quarter-over-quarter and down nicely from a year ago. Excluding the impact of delinquent loan sales, the estimated all-in annualized net charge-off rate was 4.4%, which is the same as last quarter and down roughly 40 basis points from the first quarter of 2025. Here, net charge-off rate represents the percentage of debt owed to a company that is unlikely to be recovered, relative to total loans. Including the impact from the delinquent sales, the net charge-off rate was 3.03%. This is up 23 basis points from the fourth quarter, but down 28 basis points from the first quarter of 2025. The sequential increase was primarily a function of us maintaining consistent delinquent sales of around $90 million per quarter while our balance sheet grew at a faster pace. The on-balance sheet 90-day delinquency rate was 47 basis points, down 5 basis points from the last quarter. For student loans, the annualized charge-off rate was 65 basis points, down 11 basis points from the prior quarter. The on-balance sheet 90-day delinquency rate was just 10 basis points, down 4 basis points from the prior quarter. The data continues to support our 7 to 8% net cumulative loss assumption for personal loans in line with our underwriting tolerance. Although we continue to trend below these levels, our recent vintages originating from Q4 2022 to Q2 2025 have net cumulative losses of 4.64% with 36% unpaid principal balance remaining. This is well below the 6.32% observed at the same point in time for the 2017 vintage, the last vintage that approached our 7 to 8% tolerance. The gap between the newer cohort curve and that 2017 cohort curve widened by 9 basis points during the quarter. In fact, this gap has widened each of the last 7 quarters since we began measurement. Additionally, looking at our Q1 2020 through Q4 2025 originations, 61% of principal has already been paid down with 6.8% in net cumulative losses. Therefore, for life of loan losses on this entire cohort of loans to reach 8%, the charge-off rate on the remaining 39% of unpaid principal would need to be approximately 10%. This would be well above past levels at similar points of seasoning, further underscoring our confidence in achieving loss rates below our 8% tolerance. Turning to our fair value marks and key assumptions. As a reminder, we mark our loans at fair value each quarter, which considers a number of factors including the weighted average coupon, the constant default rate, the conditional prepayment rate, and the discount rate comprised of benchmark rates and spreads. These marks are developed alongside a third party which feeds our actual loan-level data into their proprietary model and are reviewed by our independent auditor as detailed in our filings. At the end of the first quarter, our personal loans were marked at 105.4%, down 27 basis points from the prior quarter. This was driven by an increase in the discount rate, which was due to a higher benchmark rate as well as a modest decline in WAC and a modest increase in the default rate assumption. Here, WAC, weighted average coupon, is the weighted average interest rate of a pool of loans. These changes were partially offset by a modest decrease in the prepayment rate. At the end of the first quarter, our student loans were marked at 105.2%, down 40 basis points from the prior quarter. This was driven by an increase in the discount rate due to a higher benchmark rate and was partially offset by a modest decrease in the prepayment rate. The WAC and default rate assumptions remained relatively consistent with the fourth quarter. Turning to our balance sheet, in the first quarter, total assets grew by $3 billion. This was driven by $4.1 billion of loan growth, partially offset by a reduction in cash, cash equivalents, and investment securities of $940 million as a result of using some of our equity to fund loans. Total company-wide cash at quarter end was $3.8 billion. On the liability side, total deposits grew by $2.7 billion to $40.2 billion, primarily driven by growth in member deposits. Our net interest margin was 5.94% for the quarter, up 22 basis points sequentially. Here, net interest margin, NIM, is a measure of the difference between the interest income generated by banks and the amount of interest paid out to their lenders. This included a 25 basis point decrease in cost of funds, partially offset by a 2 basis point decrease in average asset yields. We continue to expect a healthy net interest margin above 5% for the foreseeable future. In terms of our regulatory capital ratios, we are very well capitalized. Our total capital ratio of 21% at quarter end is well above the regulatory minimum of 10.5% as well as our additional internal stress buffer. Tangible book value grew $4.2 billion year-over-year to $9.2 billion, including the benefit from new capital raised in 2025 as well as organic growth and earnings. The tangible book value per share at quarter end is $7.21, up from $4.58 a year ago, a 57% increase. Let me finish by providing our outlook for Q2. In line with market expectations, we now expect an interest rate outlook consistent with the Fed funds futures and no rate cuts in 2026. Now for our specific guidance for the second quarter of 2026, we expect to deliver adjusted net revenue growth of approximately 30% from Q2 '25, which would equate to roughly $1.115 billion, an adjusted EBITDA margin of approximately 30%, which would equate to roughly $330 million, and an adjusted net income margin of approximately 12 to 13%, which equates to roughly 10 to 11 cents of EPS. As I mentioned in our call in January, each year we have seasonal payroll taxes during the first 2 quarters of the year, and we are accelerating marketing expenses in the first half of 2026 in addition to our significant investments in product innovation. This increased expenditure will drive growth in the back half of 2026 and over the long term and is reflected in our second quarter guidance. Looking beyond Q2, we expect to see continued revenue growth and strong growth in EBITDA, net income, and EPS, which will get us to our full-year guidance, which remains unchanged. Overall, Q1 was a solid start to the year. We continue to have strong momentum in our business and are on track to hit our 2026 and medium-term guidance. Let's now begin the Q&A.